This is an Uncovered Japan Company research report on Nikko, ticker 6306. Nikko is a Japanese industrial plant maker whose equipment sits behind much of the country's road and airport paving. The investment question is simple. Can a dominant but low-return franchise convert decarbonization upgrades into higher margins and a valuation closer to book value? At the report's reference price of 932 yen, Nikko traded at 0.96 times book value. That discount exists despite roughly 77% domestic share in asphalt plants, a 6.3% FY26 operating margin, and a guided dividend yield of about 4.5%. The market is asking whether its returns can sustainably move higher. Nikko's core capabilities are heating, mixing, conveying, and controlling. It builds large asphalt and concrete plants, then installs, commissions, services, and ultimately replaces them. This is important because a plant lasts roughly 20 to 30 years. Once installed, it anchors operator familiarity, spare parts demand, and maintenance relationships. The segment mix explains both Nikko's quality and its problem. Asphalt plants account for 39% of sales, but earned only a 5.4% operating margin in FY26. Concrete plants earned 13.9%, while environmental and conveying equipment reached 27.8%. Nikko's upside depends less on market share, which it already has, and more on improving the margin of its largest segment. Revenue grew from 37.9 billion yen in FY21 to 49.4 billion in FY26. The more meaningful story is profit recovery. Operating margin fell to 2.6% in FY23 as materials and labor costs rose, then recovered to 6.3% and 3.10 billion yen of operating profit in FY26. Better price pass-through and more in-house fabrication helped lower the cost ratio. Nikko's balance sheet is conservative. FY26 cash of 11.5 billion yen exceeded 8 billion yen of interest-bearing debt, while the equity ratio recovered to 58%. The key limitation is return on equity. 6.8% is only modestly above the company's stated cost of equity and still below its 8% planned target. That low return is the clearest reason the market values the shares below book. Cash flow moves sharply with plant timing, inventory, and receivables. Operating cash flow was negative 1.64 billion yen in FY23 before rebounding to 4.33 billion in FY24 and 2.59 billion in FY26. For a plant maker, the useful measure is the multi-year average, which has been around 1 billion yen of free cash flow. The recurring maintenance base helps keep that average positive. Nikko's moat is not a single patent. It is an installed base with decades of switching costs. Its share is close to 100% on highway and airport paving work, while maintenance represents 61% of asphalt plant revenue and 43% of concrete plant revenue. Customers value uptime, parts availability, and the field expertise needed to commission large plants. The central strategic opportunity is decarbonization. Nikko expects energy-saving and non-fossil conversion subsidies of roughly 15 to 20 billion yen a year to accelerate upgrades to its installed base. It targets subsidy-linked revenue rising from 7.6% in fiscal year 26 to 34.5% in fiscal year 28. This can pull forward demand, but it is policy-dependent and must translate into a higher asphalt plant margin. On the report's valuation snapshot, Nikko traded at roughly 14 times trailing earnings, 13.6 times forward earnings, and 0.96 times book value. Its closest listed peer, Sakai Heavy Industries, traded at roughly 18 times earnings and 0.9 times book, with lower return on equity. The discount is therefore not just a general machinery sector effect. It reflects skepticism that Nikko can lift returns. The report's three-year scenarios are estimates, not price targets. The bear case models 618 yen, the base case 1,117 yen, and the bull case 1,717 yen. The base case assumes asphalt margin improves toward 8.5%, still short of the plan's 10.2% target. The operational indicators to watch are margin progress, order backlog, overseas losses, and whether return on equity moves above 7%. Nikko is a dominant, financially conservative, high-yield niche leader. Its installed base and service revenue are real strengths, while low return on equity, a shrinking core market, overseas losses, and thin liquidity explain the discount. The thesis comes down to one watchable test: whether management can turn decarbonization-led replacement demand into a sustainably higher asphalt margin and return on equity. This is educational research, not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.